What's going on, everybody? TG here, back with another video, and today we're going to be going over the top 5 stocks to wheel. And by wheeling, I mean selling a put until you are assigned those shares, and then when you get those shares, selling covered calls on them until you get exercised as well. So I found 5 great stocks that both pay good premium and that are good quality stocks that you wouldn't mind owning regardless. So I made this list up. Let me know what you guys think of it. But before we start this video, just like and subscribe and let me know which one of these are your favorite stocks to wheel. So first starting off, we have NIO, obviously the EV company that has had an absolute tear this year, up almost 1,500%, but is off pretty high from where it was just in January when it was sitting in the mid 60s. I think it hit 67 at the 52-week high. NIO is obviously one of the revolutionary EV companies in China that has actually backed by the Chinese government as well. And one of the reasons I really love NIO for the wheeling strategy is the premium that it pays. If we go here and look at NIO, personally, I'd recommend going 2 weeks out. I think 2 weeks out pays the best buck for your bang, so to speak. And you get paid really good premium for these. So if we go ahead and look at this, if I wanted to sell a put on NIO for the $39 strike price, I will get paid $177 per, which is pretty good considering the fact it's only going to cost me $3,900, and I'm already getting paid almost $200 to sell this put. So I would sell the put here, and you guys can clearly see the theta, all this stuff like this. Definitely read the Greeks because they're very important, especially when you're doing theta gang strategies such as selling puts or selling calls. You'll see you'll make $8 a day on the theta. Obviously, the closer you are to expiration, the higher that theta is. But that stuff's normal. The farther you go out, the less theta it is. The closer to expiration, the higher the theta gets. Also, implied volatility is very high as well. The higher the implied volatility, the more premium you will receive. So on certain things like earnings dates or big catalysts coming out, that implied volatility will spike up, and you can use that to your advantage to get more premium when selling options. So what I'd recommend, like I said, about 2 weeks out, or if you want, you can just go 1 week out and sell the puts, and you still get some pretty good premium. 39, you're getting about 114 versus if you go another week out, you're getting about $177. So it's pretty decent premium for that. But also a good thing is the calls, selling calls on it, you make a lot. If you wanted to sell a $42 strike price call, you're getting paid $126 per. Like I said, again, that's really good. That's a high implied volatility of almost 75% right there. So you'll get paid pretty well with that. So you have a small account of only $4,000 and you want to be able to make some consistent gains, go ahead and sell that put on NIO until you get assigned. And then if you don't get assigned, well, you got paid for nothing. And if you do get assigned, you get those shares. And then you can always just sell covered calls when you finally get those shares. Because if you sell a put and it goes under and finishes under that strike price, you have to buy those shares at whatever strike price you sold the put at. So that's one, NIO. I like NIO. Second stock, PLTR. You guys know me, I like PLTR as well. I own a lot of it in my main account. What I would do for this, again, implied volatility is super high on these things. You're talking 65% for PLTR. PLTR actually just had some big news today. They won a big US contract. But again, you're getting paid a pretty decent amount for not having to put up much. You put up $2,200, you make $50 for that put right there. But if you go out 2 weeks, you are getting $90 for a 22.5 put. Or you can be a little bit more risky and do a 23 put and get paid $113. And then, like I said, we flip it and want to sell the call. You go ahead and sell a $24 strike price call or even a $24.5 strike price call. You're getting paid some decent premium as well for that. So again, another good company to do this on, and PLTR is off a lot from its highs. If we look at it in the past couple months, it's really taken a hit. Was sitting around $40 in January and February, and then has crashed hard since then. The 1 month it is down as well. But obviously still having a very good year from when it IPO'd, around $10 a share. So overall, PLTR is solid, and even if you get assigned the shares, this is a great company to hold long term, has big things ahead of it. Third stock, for you bigger account holders that have about $8,000 in your account, this is the stock that I'd be doing, AMD. I own AMD in my main account as well. It's probably the best chip maker there is. That and NVIDIA are the two best of the best for GPUs and CPUs. And AMD is just something you want to hold long term. They're beating up Intel and they're just taking over the game. But if we go ahead and look at this for the puts, we go 2 weeks out. What do we see here? You do an $81 strike price, you're getting 210. You want to be a little safer and go down to 80, 164. So you get that, and then if you actually have to assign it, you can look how much you're going to get for these calls. They are a lot. You sell an $83 call, you're getting paid $138 for that. Let's actually look at the weekly, because some of you guys are like, hey, I want to do this stuff weekly. Look at this. Even for 1 week, if you do an 82.5 strike price, you're getting paid $83 per. Just some good premium every single week. That really adds up, and that is a good source of income you can have every single week. Again, AMD is something you want to hold. Also, another stock that is off its highs. Did recover some. I picked this up when it was at 75. Literally right here, I picked this thing up, and then we are up on that for our Leaps put that we sold. But again, it is off its highs from where it was in September, and actually January as well. It hit 99. And now it's sitting at 81. So again, off its highs, and really solid with a PE ratio in the 30s as well is always a great thing to see for a growth stock. Moving on to the last one, AT&T. You guys are probably like, why the heck are you picking AT&T? Well, AT&T is a company that doesn't really move much, so it's good for selling puts because you can be pretty aggressive and sell it at the 30 strike price put and get paid $30 a week for that, or you want to go out 2 weeks and you're going to get paid $43. I recommend going 1 week out with this because it doesn't really change that much. And you could also sell covered calls on it as well and get paid a little bit here and there as well. AT&T really does not move much at all. The implied volatility is low, so if you're looking for something low risk, this is great, and also pays a big dividend of about 7% a year as well. But again, look at this stock. The stock barely moves at all. And the 3 month literally kind of just sits in that channel. Had one little dip there when the whole market was crashing, but it really just stays around this $30 strike price. I think last week, I don't even think it went under 30 at all. It stayed right above 30 and under 31 the entire time last week. So again, great for that. Also great for iron condors as well. So another just great stock to do for it. You don't get paid as much as the implied volatility is super low on that. We've got 13% compared to NEO, which is sitting at about 73%. So a huge difference there. But AT&T doesn't move much, and you have a lot more safety. You don't have to worry about this company all of a sudden dropping 10% in one day, unless they cut the dividend, of course. But that's about it for AT&T. The next one is a stock pretty similar to AT&T, Pfizer. They made the vaccine that everyone's been taking and talking about. And this stock is pretty good. Let's go ahead and check out the options chain right here. And you can clearly see, again, you get paid decent premium. You pick a 36 strike price, you're getting paid $50 for 1 week on that. That's the call, actually. If you go for the put and see it, you're going to get paid a little bit less, only $18 for the 36. But if you did a 36.5, you get paid $40. So again, not much on this. Implied volatility is at 16. But the reason I like this, again, it doesn't move much, and this is a company that does pay a good dividend as well, 4.2%. So if you have a bigger account size, I definitely recommend taking advantage of this because again, you can get paid, decent money. I mean, even if you sell a 37, I mean, it's only costing you $3,600 for it, and you're going to get paid, a decent amount every single week on that. But like I said, for this one, I'd recommend probably going out 2 weeks on it just to be able to get paid a little bit extra, and then you add that up over the 2 weeks. But these are the 5 that I really like. Mainly the first 3, NEO, PLTR, AMD. But if you want something with extreme safety, this is the one I'd pick. Like I said, a little more risky ones are the NEO. They have a higher implied volatility. These ones are safer. So we started off obviously most risky, second most risky, third most risky, fourth most risky, and fifth most risky. But really, it's about what your comfort level is and what you're comfortable doing. I mean, some people are fine, just make an extra $50 a week on it. And some people want to get a little bit more. So it's whatever you're comfortable with, you go for. Because obviously, NEO and Pfizer are like almost the exact same price, except NEO's paying out, almost 10 times the amount that Pfizer's paying out. But it's also a lot more risky. With Pfizer, you don't have to worry about losing a lot at all, and you're still going to get paid about, $33 a week You know, not bad for some safety. The odds of it going under 36, somewhat slim on Pfizer, and if it does, it usually recovers right back. Again, not much movement on it. If you look in the past year, stock really trades in kind of a sideways. This is when the whole vaccine thing came out, and then it's been kind of sitting in a channel. You know, 3 months it's moved 1.5%. You know, not much at all. So it's just, again, one of those stocks that doesn't really move too much, but it's a great stock to wheel. I've owned Pfizer in the past, and you know, I've had some success with it, had some failures with it at times, but you know, overall, you're not gonna make a ton. You're not gonna lose a ton on Pfizer. It's a good stock to wheel, and you know, I recommend it if you're looking for something with not much risk. So let me know what your guys' favorites are. Personally, I think PLTR is probably the best pick for the smaller accounts. It's, you know, only $2,200 you need for your account for it, so not as much as some of these other ones like AMD. We need about $8,100. So definitely let me know your guys' thoughts, which ones you guys are, and if I didn't mention any, definitely let me know which ones I didn't mention, because I'm always up for looking for, you know, different stocks to wheel. So anyways, guys, you have a wonderful day, have a wonderful night. Enjoy this video. Make sure you like and subscribe, and like I said, let me know what your guys' favorites are. These are mine, and this is actually my small account that I'm trying to grow for a friend, and we're just doing some credit spreads right now, long term, to be safe on it. You know, just doing our thing with that. So anyways, guys, have a wonderful day. Catch you next video. Take it easy. Bye.